Welcome to another exciting episode of Financial Insights in Minutes, your go-to source for the latest financial news.
Today, we're diving into a summary of the top real estate market videos from the day.
Did you know that housing price cuts in Florida are becoming the norm?
That's right. We'll break down what's happening across the board as homebuyers face a changing market.
In this episode, we'll provide a quick summary of some crucial expert opinions and predictions.
Let's dive into the video summaries right after this brief introduction.
First, Reventure Consulting dives into the drastic price cuts impacting Florida's housing market. Real Estate Mindset reveals shocking statistics on home purchase cancellations and the role of interest rates. Next, Sachs Realty discusses whether falling mortgage rates will help avoid a market crash. Ken McElroy sheds light on the struggles millennials face in building wealth amidst soaring home prices. BiggerPockets lists the best rental property markets for real estate investors. Jason Walter provides insights from Realtor.com on the current state of the U.S. housing market. Real Estate Mindset returns with a dire warning from Lowe's regarding the economy's health. BiggerPockets features Jill Forsythe, who shares her inspiring journey of investing in real estate later in life. Welcome back to Reventure Consulting. Today, we'll dive into a significant topic: the recent plunge in housing prices by builders in Florida. Buckle up as we explore why your dream home might not be so dreamy anymore.
Absolutely. Florida's market is experiencing a seismic shift, and those builders are slashing prices like never before. Let's make sense of what's happening behind the scenes.
Let's kick things off with the core idea of today's discussion. What's really happening in Florida?
The main thesis is that the housing market in Florida is beginning to fall apart, reminiscent of the 2008 crash, as builders face record inventory and plummeting demand.
What about the inventory levels? What are the numbers telling us?
Currently, there are about 300,000 homes for sale in Florida, the highest since 2006. That's a huge indicator of market stress.
Price cuts seem to be all the rage. How drastic are we talking here?
Builders are slashing prices between $20,000 and $55,000. Can you imagine buying a house just to see it drop significantly in value?
So how about the overall pricing? What's going on there?
Home prices in Florida are currently about 30% overvalued from their long-term norms, indicating a bubble that could burst even further.
And historically, what can we learn from similar market conditions?
We're currently experiencing a market scenario parallel to 2006 to 2008, and in previous cases of high builder supply, recessions followed.
Any predictions based on what we've noted about the economy?
While lower interest rates may seem beneficial, historically, it often hints at an incoming recession. Cue the warning bells.
Looking into the crystal ball, what's on the horizon?
Expect further price drops over the next year as builders scramble, creating a situation ripe for homebuyer negotiations.
And what about the homeowners? What are we looking at?
With rising foreclosures and high-risk mortgages, many homeowners could find themselves underwater, deepening the crisis.
So how do we sum this up?
The Florida housing market is in turmoil. Homebuilders need to respond quickly, and prospective buyers must keep a close eye on these trends to avoid costly mistakes.
As a potential homebuyer, what should you remember?
Staying informed and cautious is vital in today's volatile market. What's your take? Are you optimistic or wary about buying in this climate? Let us know.
Welcome back to Real Estate Mindset. Today's topic is absolutely bonkers. We're diving into the shocking statistics behind the recent collapse in the housing market, which includes a staggering 60,000 canceled contracts. Hold on to your hats, folks.
That's right. We're unpacking why potential homebuyers are bailing left and right and how interest rates play a wild part in this story. Let's not forget the expert analysis we'll provide along the way.
So what's the lowdown on these cancellations? Why the sudden surge?
The core thesis highlights that as interest rates decrease, home purchase cancellations soar, reaching 16% of transactions in July. Buyers are feeling the heat of owning a home, not just in payments, but in additional hidden costs.
Let's break down those staggering cancellation rates. What are the key figures?
A whopping 60,000 purchase agreements were canceled. That's 16% of transactions. Talk about a nail-biting statistic.
And how are interest rates influencing these cancellations?
Interestingly, as interest rates drop, we see more buyers pulling out. This trend is likely to continue. It's like a twist in a plot nobody saw coming.
What other costs are hitting potential buyers hard?
Absolutely. Homeowners insurance averages $2,522 now, up from much lower in previous years, alongside property taxes skyrocketing since 2019. Ouch!
What's the forecast looking like?
There's a potential for home prices to drop due to falling demand. Plus, millions of homeowners are poised to sell if the rates become manageable again.
What's on the horizon in terms of cancellations?
Many buyers may still walk away, particularly if they feel costs are eating into their budget. This trend could lead us into record-high cancellation percentages into the final quarter.
And how will sellers react to market pressures?
If interest rates continue to ease, we could see a flood of sellers entering the market, resulting in potentially lower home prices.
What key takeaways should viewers remember?
Understanding that walking away might sometimes be the wiser choice can save buyers from hard financial hits. Pay attention to potential costs beyond just the mortgage.
So, for those thinking about buying, what's the advice?
Caution is key. If you're thinking of diving into homeownership, ensure you understand the whole financial picture. And what do you think? Are you ready to take the leap or happy to sit on the sidelines? Share your thoughts below.
Welcome to Sachs Realty's podcast. Today's topic is the impact of falling mortgage rates on the housing market. Can this trend prevent a crash?
Exactly. Joining us is Pamela Roman, a seasoned loan officer with over 2 decades in the mortgage industry. She's here to share her insights on the current market trends.
So Pam, what's the core message we're taking from today's discussion?
The main takeaway is that while lower mortgage rates could help buyers, the overall economic factors and rising home prices could still lead to a significant market downturn.
Let's dive into the current mortgage rate trends. What's the latest on this front?
Mortgage rates are indeed showing a slight decline, with some economists expecting cuts if the economy cools off further.
What about affordability issues? How are rising prices affecting buyers?
Affordability is still a major headache, forcing many young buyers to move back home as prices continue to soar.
Any predictions for the housing market moving forward?
We're likely to see more inventory as sellers respond to declining rates, but foreclosures could rise if economic pressures increase.
And what does Pam foresee if rates continue to drop?
If rates drop, we may see an influx of new inventory as more owners list their properties, potentially leading to increased foreclosures.
What about broader market corrections?
As inventory rises and economic pressures build, we might witness a correction in home prices, leading to industry-wide challenges.
In summary, while falling rates are promising for potential buyers, economic realities may still pose significant challenges.
Absolutely. The market continues to evolve, and buyers should stay informed about these shifting dynamics. What do you think will happen next? Let us know in the comments.
As always, it's crucial for buyers to consider the market conditions before making any decisions.
And don't forget to subscribe for more insights and updates on the housing market.
Welcome to Ken McElroy's channel. Today, we're navigating the turbulent waters of millennial wealth building as we explore whether this generation can bounce back financially.
That's right. With the unique challenges millennials face, this discussion is crucial. Ken McElroy digs deep into their financial struggles, touching on housing, debt, and wealth accumulation.
So what's the crux of Ken's argument?
The central thesis reveals that millennials find themselves in a precarious position when it comes to wealth building, largely due to skyrocketing housing prices and burdensome student debt.
Let's break down these key points, starting with the housing market.
The average home price has jumped a whopping $200,000. Millennials are expected to stabilize, but with affordability deteriorating, it's a tall order.
And how is student debt factoring into this?
Well, millennials are drowning in student debt, which limits their ability to enter the housing market. With rates as high as 10%, the burden is real.
What alternatives do millennials have for investments?
Many are opting for the stock market, crypto, and crowdfunding options, but none compare to the long-term benefits of property investment.
What does the future hold for millennials?
Ken predicts housing prices will keep climbing, making it increasingly difficult for young adults to build net worth in comparison to previous generations.
Any closing advice for millennials?
Ken emphasizes the importance of purchasing homes to build equity. FHA loans can be a game changer.
What predictions does Ken share regarding housing prices?
He believes we'll see home values skyrocket, potentially reaching $600,000, making it crucial for millennials to act now.
And what about the impact of student debt?
Ken foresees a long-term struggle for millennials because of mounting student loans, pushing them towards rentals instead of ownership.
So what are the overall takeaways?
Ken stresses that despite the challenges, millennials need to prioritize home ownership. Rent just isn't the path to wealth.
What's the bottom line on homeownership?
Investing in a home means creating equity and securing wealth, which young adults must not overlook.
What do you think millennials should do moving forward?
Leave a comment with your strategies for wealth building because we'd love to hear your thoughts.
Welcome to BiggerPockets, your go-to channel for real estate insights. Today, we're setting sail into the world of rental properties. Are you ready to discover where you should start building your real estate portfolio?
Exactly. We'll unravel the best rental property markets to maximize your investment potential. With his extensive expertise, Dave Meyer shares insights that even seasoned investors will find refreshing.
What's the key message from Dave's discussion?
The core thesis emphasizes the importance of selecting affordable markets with good economic indicators to optimize cash flow and growth for your portfolio.
Let's break down those essential points. What should investors keep in mind?
Investors can choose local markets for hands-on management or dive into long-distance opportunities. Evaluating economic growth and cash flow is key for success.
What metrics should we prioritize when selecting a market?
Look for affordability with home prices below $420,000 and rental yields of 6 to 7%. Add strong economic fundamentals, like low unemployment.
Let's discuss the best choices for remote investments. What are the highlights?
Tuscaloosa, Syracuse, and Lex stand out. With average prices around $220,000 to $236,000, they offer affordability and strong metrics for cash flow.
For those considering moving, which cities make the cut?
Pittsburgh, Oklahoma City, and Huntsville pop up due to their strong job markets and affordable housing. Even Huntsville at $310,000 remains below the national average.
What can we expect going forward in rental markets?
Investors will increasingly seek out affordable markets fostering economic growth. Keeping an eye on these trends can guide future investments.
So, what's the big takeaway from today's discussion?
Choosing the right rental market is foundational. Analyze affordability, growth, and metrics to make wise investment choices. What market are you considering? Drop your thoughts and let's chat.
Welcome to the Jason Walter channel. Today, we're diving into the intricate world of the U.S. housing market based on some freshly published data from Realtor.com.
Absolutely. There's a lot to unpack here, from home prices and inventory to the share of price reductions. Let's get straight to the facts.
What's the core message of today's topic?
Today's thesis highlights a pivotal moment in the housing market. While inventory is rising, new listings are faltering, leading to a more stagnant pricing environment.
First, let's talk about inventory. What's the latest on that?
Incredible news. Housing inventory has increased by an astounding 41% year over year. This gives buyers more options and enhances their negotiating power.
And what do the asking prices look like these days?
Asking prices have dipped by 2% over the past week alone, marking 3 straight weeks of declines. It's a clear sign of market adjustments.
Interesting. How fast are homes flying off the market?
Here's the scoop. Houses are now taking 5 days longer to sell compared to last year. That's a significant shift in dynamics.
And about those price reductions?
The number of price reductions has soared by 36.8% year over year. Currently, about 40% of listed homes are lowering their prices.
Looking ahead, what's the forecast for the housing market?
The outlook suggests sales will remain sluggish throughout the year due to ongoing affordability challenges amidst high prices.
What predictions did Jason share about market trends?
Well, he anticipates that sluggish sales will continue because of persistent affordability challenges, with home prices not easing as quickly as expected.
Any expectations on home pricing?
We expect slight price declines, but not the steep corrections we saw last year. The current dynamics just aren't the same.
To wrap this all up, What's the big takeaway?
The essential summary is that while inventory has risen dramatically, buyers are still facing hurdles with affordability and stagnant sales. Let's hear what you think.
To those watching, how do you think the ongoing trends will affect buyers and sellers moving forward?
Drop your thoughts in the comments. Your insights could help others navigate these choppy waters.
Welcome to Real Estate Mindset on YouTube. Today, we're diving into breaking news from Lowe's and their surprising warning about the economy. Joining us is Mitch Wexler, an industry professional, seasoned developer, and quantitative financing expert.
Time to navigate through these waters of economic uncertainty. With Mitch's extensive experience, he's here to help dissect Lowe's alarming predictions and what this means for consumers.
What's the main takeaway from the Lowe's updates and Mitch's insights?
The core thesis is clear. Lowe's is cutting their full-year outlook, citing weaker consumer spending. This raises red flags about overall economic health and signals a potential downturn.
Let's dive into some key points. What's going on with consumer spending?
Well, Lowe's reported earnings that exceeded expectations, but their sales targets were missed, which shows consumers are holding back on substantial purchases due to financial pressures.
Interesting. What about the pressure from interest rates?
Yes. Homeowners with fixed rates under 4% are reluctant to take on new mortgages. They're waiting for the Federal Reserve to lower interest rates. It's all tied to broader economic reluctance.
Now let's talk about data manipulation. What's happening?
The figures presented by the Census Bureau contradict what major retailers like Lowe's and Home Depot are reporting. There's clear evidence of data manipulation that obscures the real economic picture.
What predictions does Mitch have regarding consumer spending?
He predicts continuing decline in consumer spending could lead to rising unemployment rates. If people stop spending, businesses will inevitably suffer.
And what about commercial real estate?
It's a ticking time bomb. Many properties are overvalued and face significant financial issues that could kick off a larger economic collapse.
To wrap it up, what should our viewers take away?
The overarching message is that consumer confidence is waning and economic manipulation creates a false sense of security. Viewers, what's your take on the situation? Leave your thoughts in the comments.
What actions can viewers take moving forward?
Stay informed and watch these trends closely. What strategies are you employing during these uncertain times?
Welcome to the BiggerPockets podcast. Today's episode is a treasure trove of inspiration for anyone thinking it's too late to dive into real estate investing.
Absolutely. We're joined by Jill Forsythe, who began her investing journey at age 54. Talk about a late start with a bang.
So what's Jill's core message for us today?
The main thesis is that no matter when you start, you can carve a path to financial stability through real estate.
Let's hit those key points. Starting late is possible, right?
Exactly. Jill launched her investing journey in her 50s, proving it's never too late.
What factors made Jill's success possible?
Having a stable income stream and some savings allowed her to invest confidently.
How about financial habits?
Good money habits, living below your means and saving, are essential regardless of age.
What was Jill's experience like managing properties?
She tackled some tough properties and learned valuable lessons on management.
And what about setting goals?
Jill emphasizes that investors need to be clear about their goals and flexible as they grow.
Looking ahead, what do Jill's insights suggest for older investors?
We can expect more older investors to enter the market, thriving in real estate.
To sum it all up, Jill's journey shows us that age is just a number.
Absolutely. Investing in real estate is possible even later in life. What are your thoughts? Have you considered starting now?
As we wrap up, it's clear that the housing market is navigating a series of challenges, from Florida's drastic price drops to the high cancellation rates amongst home contracts. Experts are seeing red flags.
Ken McElroy and others warn about millennials struggling to gain a foothold in a market that seems increasingly out of reach.
However, some suggest that falling mortgage rates could offer footing for buyers, even amidst economic uncertainty.
What do you think? Will these trends help stabilize the market, or are we in for more turbulence?
Thanks for watching Financial Insights in Minutes for August 21st, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.